Hello, I'm Jay Bryson, the Chief Economist of the Corporate and Investment Bank at Wells Fargo, and I'm joined today by my colleagues, Tim Quinlan, Mark Vittner, and Nick Benenbrook, to talk about our annual economic outlook for the next 2 years. Before we do that, though, however, let me just say here at the top, what we're going to talk about today is our base case. The recent emergence by the Omicron variant certainly throws in a lot of uncertainty into the environment here. We're certainly not expecting any lockdowns of economies. We don't think there's a lot of political support for that. But if this thing gets really out of hand, people's behaviors could change. And so, we'll see how this all plays out. But again, this is our base case sort of scenario. So given that, Tim, how are we thinking about growth as we go, U.S. economic growth as we go into 2022?
Well, Jay, our base case expectation is that by the time they close the books on 2021, it'll go down as one of the best years for economic growth since 1984, with full year numbers coming in just north of 5%. We're expecting growth to moderate in each of the next couple of years, with about a 4% growth rate in 2022 and somewhere between 3 and 4% in 2023. What gets us there is a lot of the things that has propelled growth this year. A continuation of what has already been pretty strong growth in consumer spending. But what you notice here is a continuation, a transition that's already underway between goods outlays supporting the consumer spending to a broader transition to services outlays. And as we continue to move farther away from the pandemic, there's a scope for that to continue to grow. Business spending is also continuing to contribute to the growth outlook. If you look at core capital goods spending, it already is higher above its pre-pandemic peak than it reached in either of the prior two cycles. Households are in pretty decent financial balance sheet, so are corporations, and both of those factors help propel growth to what is above trend growth in each of the next 2 years, even if it is at a somewhat moderating pace of growth.
Okay, that's great. But what about inflation? Inflation has certainly raised its ugly head lately. Where do you see that going?
Right. Whether you're talking about headline CPI or the Fed's personal consumption expenditures deflator, both of these measures are as high as they have been in about 30 years or more. And the net impact of that has been a lot of pressure on both consumer confidence and something that makes its way into almost every earnings announcement on Wall Street these days as corporations worry about the impact of higher prices on the profitability of their corporations. Now, in our view, this sort of hand-wringing about inflation is both justified and kind of nearing the end of its critical period. In other words, while we do have above trend growth in inflation for each of the next couple of years, we see the headline rate of inflation coming down perhaps as soon as late first quarter, certainly by the middle part of next year. And a lot of that, Jay, has to do with base effects. If we take lumber for an example, everyone remembers when lumber prices were kind of going through the roof last year. And if you look at lumber prices today, they're down about 30 to 40% from where they were in May of last year. A number of other commodities could be substituted in that calculation. And what it basically means is as you bump into those higher price points, as we get into their anniversary dates in 2022, it becomes harder for that headline inflation rates to continue to rise as fast as it's been. It'll still be above the Fed's target all of next year and probably a bit above their target in 2023. But I'm actually curious, Jay, what all of this means in terms of the pressure on prices, in terms of what the Fed is going to do, not just in terms of the asset purchase program, but also in terms of eventual adjustments to interest rates.
Well, that certainly is a great question. It seems recently inflation has definitely got the Fed's attention. They've been calling it, they think inflation is transitory recently, and it seems like they're starting to drop that somewhat. And so what this all means is the Fed is probably going to start to speed up its tightening cycle. Now, we don't expect them to go into overdrive, but they are winding down their asset purchase program right now. We think that'll be done sometime this spring or maybe even in, as late as the summer, and then they'll start to hike rates thereafter. So next year, we're looking for about 50 basis points of rate hikes from the Fed, followed by another 50 basis points of rate hikes in 2023. And a good question here would be, so if the Fed can't really control what's happening to semiconductor chips or boats or things of that nature, why are they hiking rates? And I think the answer really gets back to inflation expectations. By showing their commitment to start to tighten policy here, it can keep inflation expectations in check, and therefore, hopefully, we don't have runaway inflation.
Well, that tells us what we need to know about what the Fed is going to do. But we've had a couple of years where Congress has been pretty generous in terms of fiscal stimulus. So, what are our expectations around fiscal policy?
So, as you know, we've already signed, or President Biden has already signed an infrastructure bill worth about $1 trillion on quote hard sort of infrastructure, bridges, roads, things of that nature. About 550 billion of that would be new spending. And there's a soft infrastructure package working its way through Congress right now. This would be things like universal pre-K, child care, a boatload of other sorts of things in there as well. We would expect that eventually Congress does pass a soft infrastructure package somewhere in the order of maybe $1.5 trillion, maybe $1.75 trillion. And the big question is, what sort of effects does this have on the economy? And it would boost the economy, it would boost inflation, but generally on the margin. I mean, these are big numbers we're talking about. It's $1 trillion in hard infrastructure. It's $1.5 trillion or so in soft infrastructure. But remember, those things are spread out over 10 years. Okay, so we're looking at $100 billion, maybe $200 billion a year. That's a big number, but it's also in the context of a $23 trillion economy. So again, these infrastructure packages can boost growth at the margin. It can boost inflation a little bit at the margin, but we wouldn't think that they would cause runaway inflation by themselves. Again, because they're spread out over a decade or so of spending. So, Mark, obviously, there's been a lot of different regional impacts of this pandemic here. What are we seeing on the regional sort of front, and who are kind of the winners and the losers as we go forward?
Well, the pandemic really accelerated a lot of trends that were already in place. We were seeing a bit of an affordability migration from the high cost areas of the West Coast and parts of the Northeast to the South and the Mountain West. And the pandemic really accelerated that because not only were these places along the West Coast and Northeast more expensive than areas in the nation's interior, but they also locked down harder and they were slower to reopen their economies. And so we saw the outflow of folks from these areas accelerate. And the Mountain West states, particularly Utah, Idaho, Nevada, Arizona, have been some of the fastest growing states in the country. And Texas has probably been the biggest winner because they've seen a huge windfall in corporate relocations and continue to see very rapid population growth in all of their major metro areas. The Southeast is another hotspot. Tennessee, Georgia, the Carolinas, and most of Florida have grown very rapidly. The states that had locked down the hardest, the large states, New York, Illinois, California, have all seen a bit of a comeback more recently. When we saw the return of in-person learning and colleges open back up, that was really good news for Boston and New York, and we saw apartment demand really come on strong. And they are those states that lagged in the early part of the recovery are now coming to the forefront and seeing some of the strongest job growth.
Okay, well, great. Well, thanks for that. But what about real estate as well? Winners and losers in terms of real estate. What are you looking at there?
Well, in terms of the product mix, certainly housing has boomed. It took off right as the lockdowns ended. The pandemic really increased the demand for housing, both from folks that already owned homes. They appreciated their homes more. They spent a lot of money to improve them and make them better suited for working remotely and for remote learning. And we also saw that a lot of folks that were renting wanted to buy, and there was very little supply, and so the price of houses surged tremendously. And builders have been very slow to respond because we have all sorts of supply shortages and labor's in short supply And so prices are up quite a bit, and they're up quite a bit throughout all of the country. The largest increases are taking place in markets that are seeing strong population inflows. We've also seen a lot of investor activity, which has pulled prices up even more. In some markets, investors are making up almost 1 out of every 3 purchases. In places like Phoenix, in Atlanta, and Charlotte, the investors are incredibly active. But on the other side, the office market and the hotel market have been the weakest markets. The return to the office has been delayed several times. And we have seen that some markets have come back a little bit quicker. It's the Texas markets. And by and large, it's markets that are more dependent upon folks commuting into work by car as opposed to using mass transit. And the areas that have really lagged have been San Francisco and New York.
Okay, well, thanks, Mark. So Nick, up to this point, we focused almost entirely on the U.S. Let's talk about the rest of the world. How do you see growth and inflation in the rest of the world over the next 2 years or so?
Yes, thanks, Jay. I think when we look at the rest of the world, we see similar, maybe not exactly the same, but similar patterns as here in the US. We do expect there'll be some moderation in GDP growth globally. For ourselves, we're looking at GDP growth in 2022, maybe 4%, slightly above that perhaps. And in 2023, maybe 3% or slightly above. So slower than the pace of growth that we saw this year in 2021. And I think a couple of things going on there. Certainly we had a bit of a surge in growth as the economies reopened at varying speeds. And so you're naturally going to see some moderation there. And then I think the other thing that's important from the growth perspective and why we do see some moderation is a couple of very important dynamics with respect to the consumer. First, if we look across a lot of the major developed economies, we are seeing historically high household savings rates are actually starting to come back, not yet to normal levels, but have at least declined closer to normal levels. So that excess savings is sort of working its way through. And of course, we have also another dynamic in terms of consumers, households, and a lot of these economies are sitting on large stockpiles of cash in terms of this excess savings over a period of time. So as those stockpiles of cash get spent and as those savings rates return to normal, I think we're going to see consumer spending trends sort of also more normal. And that's why we do see that moderation in growth sort of towards the 4% to 3% levels that I mentioned. Certainly I would say the United Kingdom and the Eurozone, they could lag a little bit. Canada looks pretty good in terms of the outlook over the next couple of years. From an inflation perspective, we are seeing some inflation, certainly in the emerging markets, the likes of Mexico and Brazil, also in the major developed economies. If one was looking at Canada, the Eurozone, and the United Kingdom, our forecast for inflation for 2022 is anywhere between 2.5% to 3.5% in terms of the headline inflation. So that's not quite as much as we're seeing here in the United States, but certainly faster inflation that we're likely to see in 2022 compared to 2021. And some of those supply shortages and product shortages, supply disruptions that have been so prevalent here in the United States, there are certainly echoes of that globally, and we'll see inflation move higher. And so, just looking at the global CPI inflation outlook for 2021, maybe around about 4%, we're actually looking for slightly faster inflation overall next year, 4.5% globally for 2022.
Okay, so then what does that mean for foreign central banks, and what is the implications then for the US dollar?
Yes, well, in terms of the foreign central banks, they are certainly paying attention to some of these inflation upticks that I mentioned. Now, a couple of those central banks have already moved. Central Bank of Brazil, Central Bank of Mexico, and among the major developed economies, you can look at places like New Zealand and Norway. It's somewhat smaller economies, but they have already moved in terms of their rates higher. When we look at 2022, we think the likes of the Bank of England in terms of the United Kingdom, the Bank of Canada, we could see multiple rate increases, and those central banks could have their policy rates by the end of next year, 2022, somewhere close to 0.75% to 1% by the end of the next year. So we are expecting interest rate increases. Perhaps the exception could be, or probably will be, the European Central Bank, they will likely continue with their bond purchases, taper, but at a very gradual pace. And I'd be very surprised if we saw rate increases in 2022. And it's possible we might not even see rate increases from the Eurozone through 2023 as well. We suspect that the Eurozone will be more gradual. As for what that means for the currency markets and the dollar, I would say, although we do expect these rate increases, when you look at kind of what investors, market participants, people are hoping or expecting from some of these foreign central banks, they're actually expecting they might even move a little bit more quickly than we forecast. And so in that sense, if one was to say that these central banks disappointed, and when I mean disappoint, not raising rates as quickly as might be currently expected, I think what that means is that some of these foreign currencies may actually face headwinds, face challenges next year. And so our overall US dollar forecast at this point is for strengthen the US currency against most of the major developed currencies as well as the emerging currencies through pretty much all of 2022. And our base case scenario, we're probably looking for a gain in the US dollar over the next year, maybe a gain of around about 4% on average against all of these currencies, plus or minus. One wouldn't want to be too exact, but I certainly think in the region of 4% gain next year. So we expect US dollar strength to continue.
Well, thank you, Nick. And thank you, Tim and Mark. And thank all of you for joining us today. The situation certainly is evolving out there, and as it continues to evolve, we will update our forecast and we'll bring you more videos like this as we go forward. So again, thank you very much for joining us today.